Ladies and gentlemen, welcome to today's 16th Cancer Charity Support Fund investment talk. Thank you for making it over to us through the snowstorm and everything. Very happy to have you here. PMG puts together this event since 2012 in order to collect donations, to raise awareness, to find others, to inspire others in the financial industry to engage themselves in the fight against cancer. And so I'm very happy to have so many of you here today. Before we start the investment talk, because after all it's called the Cancer Charity Support Fund Investment Talk, before we talk about investments, let me just spend a little bit of time on charity. So essentially you can do donations in two distinct ways. One, by doing non-earmarked donations to a broader organization, and the other possibility is through doing earmarked donations to a specific cause or to a specific recipient. Now, you will not be surprised to hear from me that today you can do either of them, and by help of this piece of paper. So I would like to highlight the fact that today we're collecting donations for the Hilfsfonds zur Unterstützung von Krebsbetroffenen. This is a fund which was launched by the Krebsliga to deal with hardship cases. I'm not talking about people who are well insured, who are supported by their families and communities, but I'm talking about real hardship cases where people are dangerously put off their normal life rhythm by the life-changing illness that cancer still is today. So we're talking about really difficult situations where this fund puts in some practical help for people who are affected by this. Now I have with me, my name is Volker Farnold, by the way. I work for PMG. To my left I have Bettina Juncker, who is in charge at the Krebsliga for marketing, communication and fundraising. And further on to my left I have here Sami Davish, who is in charge of corporate fundraising at the Krebsliga Schweiz, Krebsforschung Schweiz. And the plan is, if you have some charitable appetite today and you can decide to help us with our cause, Sami will be standing by the exit at the end of this event and will be collecting this sheet, so you can make a commitment on either the fund or a direct donation to the Hilfsfonds zur Unterstützung von Krebsbetroffenen. You can also sleep over it. You don't have to fill in the numbers right now, but at least put in your name and your email address, and then Sami will contact you in about a week's time and see if your appetite for charity has increased. Bettina, over to you.
Can you hear me?
I think we have to switch it on. Hello? Try it again.
Hello?
Now. Yeah.
Okay. Yes. Thank you. Thank you, Volker. Your commitment is really outstanding. We see it today in this beautiful platform with the great guests you could mobilize to be here, so thank you very much. Also, the Swiss Cancer League really appreciates all that PMG does for us, you know, in introducing new sponsors to us, in promoting the Cancer Charity Support Fund, and you know, to provide platforms like this one. So thank you very much. And I know it's your personal commitment, Volker. It is. So let me come back to the sheet. It disappeared.
Which is here.
Thank you very much. The second option you have here on the left-hand side is to sign for the Cancer Charity Support Fund. You can sign the fund and by doing this generate donations in another way. You know, or you might already know it, that half of the performance of the fund will go to the Swiss Cancer League and the Swiss Cancer Research. half of the annual performance as a donation. So a perfect way also to do something good. The fund, by the way, was launched in 2009, for all those who are not aware of that. And ever since, all in all, the fund generated donations of 3.2 million Swiss francs. So I think that's another applause for you, Volker. Really a great achievement. Let me say one or two words concerning the non-earmarked donations. You know, as long as someone supports a project of the Swiss Cancer League, that's perfectly fine. But what we also need are the non-earmarked donations, which help us to finance just the core activities of the Swiss Cancer League, which is basically, you know, providing support, providing help and advice to people who have cancer, to their families and their caretakers. The help we provide in that way goes far beyond what doctors and hospitals can do in their medical therapies. We have, for instance, the cancer helpline. I don't know if you've ever heard of that. It's a telephone helpline, but it's also a chat. You can reach our specialists by email, by Skype, and they also maintain a forum in which you can, at any time of the day, discuss with others or discuss with us about your problem. In order to be able to keep up that helpline, we need specialists. We cannot use just a summer intern, as you put it yesterday. We need experts, they cost money, and they have to be knowledgeable in the medical field, in the psychological field. They have to be strong personalities who can handle any call of a person in distress, and before they pick up the phone, they never know what's going to be next. So that's a really, really tough job. The Swiss Cancer League and the Swiss Cancer Research are by over 90% financed, privately financed, so we don't have any money from the state. And we can promise you that we are a highly efficient organization with a very small overhead, so to make sure that the maximum benefit goes to the people who really need it. So again, thank you very much, Volker, thank you, PMG, and thank you for being here and for listening to us and to our cause. Please do your donations if you like to, either directly or by investing in the fund, as Volker already told you. At the end, you already mentioned it, Sami will collect the sheets. You can talk to me or talk to Sami with whatever question you have. We're very, very happy to answer your questions. So thank you very much.
Thank you, Bettina. So we're all aware about the process, how to make a donation. You can either do it earmarked or non-earmarked, both ways. So just what does that amount to? The Hilfsfonds für Krebsbetroffene has an annual deficit of about 350,000 Swiss francs, and we're trying to help close that gap. The last event brought direct donations to this fund of 2,500 Swiss francs. So we're trying to improve that number going forward. And we had one subscription of 100,000 Swiss francs for the fund. So up to you to improve the situation going forward. And now let's talk about the investments. We have a fantastic panel here today. Thank you, Bettina. I was shocked the other day. I read in the Financial Times today there are more stock indices available to investors than individual stocks. So let that sit for a moment and think about what that tells us about active investment and passive investment in these days. So today I'm very happy to have a panel of three proven non-passive, very, very active contrarian investors who are all doing something very special to avoid being part of the benchmark. And I would like to briefly introduce each one of them, starting with our guest who just came this week from Toronto, Tim Regan. He works at King West in Toronto. King West is a boutique value investment manager with more than $1 billion worth of client assets, focusing exclusively on North American equity. Tim is started his career at Templeton. He is with King West since 2003, and he's the head of the investment board there. He replaces today Richard Vogler, who for medical reasons had to cancel this trip to Europe last minute, but Tim will be able to stand his ground on anything related to stock investment, value investment. He is, by the way, also a lecturer at the, the Rotman School of the University of Toronto, where he gives classes in value investing. So thank you, Tim, for being here. In the middle, we have Thomas Braun. He is the co-founder of Braun von Wies und Müller. He is a portfolio manager and investment analyst for over 35 years. And 20 years ago, he decided together with two partners to take a step outside the general system, create his own firm and start value investing without any interference and full independence from outside forces such as banks. So Braun von Wies and Müller doesn't need much introduction. They manage more than 1 billion Swiss francs. Since they started the fund has returned somewhere around 10% annualized compared to indices, world equity indices that have returned 4%. That's a very, very successful track record Thomas has been able to establish. When he's not managing funds, Thomas is working hard, has been working hard and still working hard over the past few decades for fair investor information. So he's been vice president of the Commission Information to Shareholders and a member of the accounting experts group of the Swiss Stock Exchange. And between 1995 and 2016, he's been on the board of the Swiss GAAP FAIR, which is an interest group for public shareholders. Thank you, Thomas, for being here, taking the time to tell us about your experience. Last but not least, the moderator today is also a value manager in his own right, Michel Degoschu. He studied at WHU in Germany. He holds a PhD from the University of Basel. And basically, right after his studies, he decided to create a company to launch indices on private equity, on listed private equity. And that was the basis of what he is doing today. So he's coming from the index world. In 2009, he started the listed private equity fund together with PMG, which is a value fund focusing on this specific small niche in the equity market. So maybe staying within the personal biography, Michel, can you tell us a little bit about the step from being an index provider to becoming a value manager?
Yeah, as you said, we started in 2004 analyzing listed private equity stocks and launched the first private equity indices. And then in 2008, 2009, we had seen huge discounts on private equity stocks. We have seen that investors were basically selling off that type of investments, the discounts on the portfolio on private equity funds, be it listed or not listed, whether it's a good portfolio of investments or bad portfolio investments, were trading at very huge discounts. And that was basically the motivation to launch a value fund in private equity stocks in 2009. Now, more than 9 years ago, we still see discounts in the market. We can still perform our value strategy. And on single company levels, we still have up to 50% discount when we compare the market price to the book value. But I would like now to start our discussion with Tim. Tim, you started in the 80s with John Templeton. Maybe you can tell us something, some lessons learned, some insight from that time.
Well, it was very interesting. I was a young man in the 80s and started with Templeton. Templeton, although John Templeton is an American who later became a Brit, the Templeton funds were first started in Canada. Oh, thank you, Walker. Can everybody hear me okay? Here it is. Is that better? There we are. Okay. Canada, believe it or not, in the 1950s was a tax haven for U.S. investors. So that's where a lot of mutual funds were started in Canada for American investors. It was interesting being a young person working at Templeton, learning the value system. But the interesting thing about Sir John Templeton was he wasn't just a value manager, he lived it every day. In fact, when he came up to Toronto, I'd wander around with him. And back in the old days, we didn't have cell phones. So he'd always turn around, try to find a payphone to find out what was going on, and always ask me for a dime, that's our 10-cent piece in North America, to put into the payphone. All I know is today he still owes me a lot of dimes. That's a value investor.
Thomas, why did you found Brown with Miller 20 years ago? Maybe would you encourage a young student from today to start a career in asset management?
Yes, definitely. I would encourage every young man to be in asset management because it's extremely interesting to study companies and all what's around these companies. So we're linked to the world, to politics, economics, psychology. Actually, I'm for 36 years in the business. You can see it, Volker. And I don't remember having one day which was boring. So I think, yes, it's exciting. You asked me, well, why you started your own company. That's a good question. I would say, as a contrarian value investor, it's hard not to be your own boss. I think it's understandable if I think at the boss who should be my boss. In good times, of course, it's okay. But you know, in investing, you always have periods where you do not have that good times. And then to defend a portfolio with unpopular stocks, this is really a career risk. So finally, yes, we decided together with George Van Wees, my founding partner, who was in those times my best employee, my best analyst, we started our own business. And I think we have been lucky as well as hardworking, yes.
And you have a pure bottom-up analysis. Maybe you can give us an example of a topic of one of your current investments.
Yes, I can give you many examples, but I mean, our investment process is structured, it's clear-cut, it's straightforward. Actually, the game is to find companies which are heavily undervalued, and at least since Bob Schiller was on the stage 2 years ago, when he did the study where he got, for which he got the Nobel Prize, by the way, I think 20 years ago, 20 years later, as usual, he really showed that there are regularly huge differences between fair values and the stock price. And I think behavioral finance showed us why. You have herding, you have overreaction on negative events, etc., etc. So we try to exploit these mechanisms, finding ideas. We have data bank screening, we talk to brokers, we study financial news, we talk to companies. There are even conferences for value ideas. So we take this all, and then the work starts. And what we do, and it's important to see value investing. I think there are two camps today. You have the Benjamin Graham camp, where you really want a huge margin of safety, a huge difference between price and value. Then you buy and you sell at fair value. That's what we do. And then I would say you have the Buffett camp, which he changed, I would say, over time, his investment style, because he started as a band guy, and now he's an investor on his own, of course. And he is paying, I would say, quite frequently full price for good, excellent companies. And he doesn't sell at fair values. He's sticking to his investments. That's a huge difference. And if you talk about value investing, I think you as an investor should always ask which camp you are. What do you do? So valuation, and then I stopped. I told you to stop me if I'm too long. No, I mean, fair value, this sounds good, but it's not that simple to figure out what is the fair value. And our approach is, we look at normalized average operating margin over the circle, and this is the base for our valuation. Then all the other stuffs come quite easily if you figure this out, business by business, because most companies, they consist of many businesses, or certainly not one. And the other element is the multiple we use, and this is again an average multiple over cycle.
So which type of multiple?
It depends.
P multiple,
I mean, if you look at private banks, for example, I would say over the cycle you pay 14, 15 times earnings. It used to be more, but I think we had some structural shifts. And finally, what's in the multiple is, one, the growth characteristics, and on the other hand, some risk characteristics. So this is different from company to company, from industry to industry. So yes, you have to study the past to have a good shot in the future. And finally, that's what we do. And then we hold a portfolio of about 25 to 30 companies. So we are quite concentrated. And as I said, we buy cheap and hope to be able to sell at fair value.
And you would like to mention a topic?
Excuse me?
Would you like to mention a topic of an example company of your current portfolio?
Yes, I mentioned a private bank. And I mean, I think you wrote, I'm a contrarian investor, so I would like to endorse this kind of reputation. Of course, the name I will give you is a very unpopular one, as usual when we start to invest. And I hope with second thoughts, you're going to like it. The actual situation is, for example, now EFG. I mean, this is an awful story over years. With the merger with BSC, this was another hit, and there are still some issues with the Taiwan case. They have this life insurance stuff, etc., etc. But basically, it's still a private bank, and operationally, they are on their way to make this year probably about 200 million net profit, and I guess next year 250 plus. And this is not because the markets will be great. It's simply because they can cut a lot of costs. Alone, the integration of the IT system is going to bring about 80-90 million per year. So if you have a company probably making 250 next year, and the market cap is 2.3 billion, and it's a private bank, and I told you before the multiple is about maybe 14, 15, you can figure out where the price should be in 1-2 years. So this is an example. And
Interesting,
now I
yeah.
think
So
he will tell us some of his examples.
interesting thing with Tim is he's also investing into private equity stocks, and as I mentioned, LPX is only investing into private equity stocks. So I was it was good to see that also other value managers are seeing value in this asset class. So maybe you can tell us why you also investing into not only of course, but what was the rationale behind it to invest into private equity stock?
Sure. As value investors, we'll go anywhere. We are industry agnostic as to where we want to make money. It's about that value gap. And really, as value investors, what we're really doing is arbitraging what is perception in the marketplace and what we think reality is, the value of a business, whereas perception is the price it's trading at the moment. A number of years ago, I think it was about, it would have been 2010, not quite 2009, we made our first foray into a private equity company called Blackstone. And I think everyone knows Blackstone, not to be confused with BlackRock. But Blackstone has become, I think they now are the world's largest private equity manager, but there's really 4 pillars to the business. One was a hedge fund of funds, which is not really growing. It's a little bit on the decline. One is private credit, private equity, and also private real estate, which has really been the growth engine. When we first looked at Blackstone, it was trading at about $13. Now, one thing people don't realize, it went public at $30 in 2007, 2008, before the large correction. We looked at the underlying assets and what they did and thought, this is a great time to get into private equity. It's so undervalued. Everybody's fleeing it. So we got in at about $16. We're not always going to catch the bottom as value investors. That's one thing. Anyone who's waiting for the bottom, you'll never find it. Usually when we buy something, it goes down a little more. It makes us feel comfortable. But anyway, we got into Blackstone and we've held it ever since. Today, it's $33. It sounds like it's a large movement. It's doubled, but it's been quite a long time. The other thing, though, is that they've given us about an 8 to 10% distribution every year. Now, it's interesting. It's trading at $33 today. We think it's worth $55 for many reasons. And when we look at it, really what the market's valuing Blackstone at is really just today's fees, just what their regular management fees are. There's no value to the carry at all. Blackstone's also been growing. They've been raising a lot of money. They have a lot of what they'll call dry powder that hasn't been invested yet, so that's not earning fees. Eventually it will get invested as well. So when we look at it today, and if they just do what we would consider a mediocre job, not doing what they've done in the past with their private equity and real estate, but bring it down to about 12% rates of return, we think the company's worth $55 just looking at the fees that it will collect based on that. They're also growing. There are limits to growth, but they've been doing a great job. And the interesting thing, as I was mentioning as well, is there's another little catalyst in between. We've seen Donald Trump did tax reform in the US. So basically what that means to Blackstone, it's a limited partnership. It was a limited partnership because they were arbitraging corporate and individual tax rates. Stephen Schwarzman, who is the CEO of Blackstone, has mentioned that he is looking at moving it to a corporation. He's not guaranteed that, but he's looking at moving it to a corporation. So what does that mean? Well, Blackstone is a $40 billion limited partnership. It's not in any index. It's not allowed to be included in an index. If it becomes a corporation, it will become part of the index, and we think it could bump up 10 or 15% right away. That's not why we own it, but it's a nice catalyst to have.
Well, actually, it's part of our index. So, but you're right, not part of the
S&P 500, the larger, broader base.
Would not include it. Yeah. I mean, what is the current value gap on your portfolio level? I mean, when you say $55 for Blackstone, currently trading at 33, I mean, is this
so our
representative for your portfolio?
Sure. What we try to do, our portfolio gap today is about 33%, and that's the weighted value of where we think the share prices should be in the next 2 to 3 years. What we do is just where we get that gap from is we go in looking for about a 40% gap over 2 to 3 years when we initially buy a company. A lot of people think that's very, very aggressive. So essentially we're almost looking for 20% a year. Have we done 20% a year? No, I think in the US we've done, 12.5 over the last 25 years. So people say, why have you only done 12.5? Well, the one thing we can tell you up here, you can say this too, we do make mistakes. And so that's why we have portfolios. We hold as well about 25 companies. But if you look at it, CRISP, that's from the University of Chicago, the Security Pricing Institute, they say 30% of a portfolio manager's decisions are mistakes. So if we're lucky, we don't lose any money on our mistakes. Basically, if you're looking at 40% over 2 to 3 years, you're looking at about a 13% return. So we like to work backwards. If we're going to produce superior rates of return to the index, we actually have to have a formula of how we're going to get there and make sure that the companies that we buy and when we buy them fit into that formula.
And do you have any macro views that goes into your analysis?
We actually try not to have macro views. The one thing, usually when I'm speaking in Canada, the one quote I always have is from, apparently it's from John Kenneth Galbraith, who is a famous Harvard economist, President Kennedy's ambassador to India. But he said the only function of macroeconomic forecasting is to make astrology look respectable. So one thing we can't do is forecast the market. We are very aware of the macro effect. We have to be aware of how it can affect the portfolio. And I think if anything today, if I looked at our portfolio, we would have a bias towards rising rates. And we have for the last 2 or 3 years. Didn't help us as much over the last 2 or 3 years, but we think that's where the marketplace is going. But one thing you do is you don't count on that when you're valuing a company.
Thomas, would you agree? Do you also, or do you have any macro views, and does this flow into your analysis?
Yes and no. But first, I would do back Tim by saying, yes, you need a portfolio because in our business, you're always reminded to stay humble because you really make mistakes. So not any investment is a good investment. Sometimes you can save it by adding up if the stock goes further and further down. But yeah, this is an important point about investing. Macro, Galbraith, I think he's right. I mean, it's very, very difficult to time the market to say when will the next recession come, etc., etc. I think what you can do is to figure out where you stand in a cycle, but to say where it will go, it's very hard. I make an example. I mean, traditionally and historically, a bull market ends when the economy is going to overheat. Because then if inflation is growing rapidly about 3%, 4%, central banks are forced to do something, and this means they have to aggressively increase interest rates. And finally, you will end up in a recession. So, but when the point is reached, it's very hard to say. I mean, you can look, where do we stand today? I do not see overheating. I do not see an aggressive central bank policy, not yet. So you could see from this point of view, there is some room that the bull market is going on. There is not a reason why it should correct. Same holds true for valuation. Valuations, I think the S&P is trading at about 18 times earnings. The The long-term average is about 15 times, but interest rates and inflation are clearly below average. So if you do studies and study the situation, you can say with inflation rates below 2.5%, the usual PE is at about 18 times. So you could say it's still fair, because I mean, if the markets would trade at 30, 40 times and inflation would go up rapidly, you really had to think what you're going to do. But probably the market would be faster than you, and you would even have had the correction where you should think about what to buy. So it's difficult.
And do you see any market segment where there's currently too much optimism?
I think what we have seen in Amazon and stuff like this, I would say yes, it's hard to justify the price. And in general, if you look at Swiss companies, and I always look at these overviews with usual multiples, I think most companies are well priced. They are not really overpriced. But you cannot say, well, this is, oh, I have to look at. It's so cheap. It makes me look at. Actually, we look at other countries. Maybe one example, one exception could be Aritza. But I think not yet, because the balance sheet issues are too heavy. And I think they said they will not do a capital increase, unfortunately. But if they do, finally, then maybe you should look at the company. Yeah, that's more or less the situation.
And maybe do you hold any cash position on a portfolio level? Maybe.
Yes. Today we are fairly high in cash. It's not an indication on the market. It's just an indication on what we've been selling and what we're buying. So I think we're about 20% cash right now, which is fairly high. However, we've been doing a lot of work on a lot of different companies. We've had one company we're just starting to buy into today. Normally, as I say, with 25 companies, we initially wait with a 4% position. So I guess we have 5 companies to buy. We'll probably, depending on the price of that, we're waiting on the price to come to us, and it's very volatile. We'll fill our position, but we're doing a lot of work. And in fact, if we do get a temporary correction in the US market, I'm sure we'll put that cash to use quickly. The only problem is that we want a temporary correction in what we want to buy, not what we own. So that's what you need to see. When we did get that correction, it was very funny because some of the things we own were down with the market. Some of the things we wanted to buy actually went up. But and that happens because when you're buying companies that are value companies, there's usually a problem with them. There's a misperception in the marketplace, so they tend to act independent of the price mechanisms in the market in the short term. So we're actively looking to put that cash to use.
So you will decrease it to zero?
We hope to. That is our goal. Usually when we're investing, we run with about 5% cash at any one point. It's just that as value investors or any investors, every time you sell something, there's not always an obvious buy. And every time you buy something, there's not an obvious sell. So sometimes in some markets, you want to buy more than 25 positions. It gets a little tough.
And your regional focus is mainly US and Canada?
That's correct. When we say mainly US, we do have some international companies in the portfolio. We have Vodafone in our portfolio. Okay. It's a good play on the emerging markets, sub-Saharan, but we found it to be cheap. But we really found it through when Vodafone and Verizon were going through their breakup, we'll call it. We own a few, it's interesting as well, we own a few companies that are American companies, but they're based in Ireland, much like Apple. So maybe they'll be based in America again after the tax reforms.
And in general, what is your process to find that type of stocks?
So to find the types of stocks, much like Thomas, anywhere, anything. We're constantly looking. We have different information feeds. We talk to a lot of people. We look at a lot of different sources, even shareholder activism. Maybe I'll mention it because we usually don't talk about stocks. We're legging into a company, and it's called Newell Brands. The brands they combine with a company called Jardine, but they make rubber garbage cans, but they're also Sharpie pens. There's a whole host of iconic brands that they own, and it wasn't well managed. We just started to get into it, then we found out Carl Icahn took a run at it the other day, and Starboard Value Investors, and they're replacing the board. So actually, I think we may have a fuller position because it went down, but it makes us feel a little more comfortable when we're buying something that is down about 45% from its high. It has a great brand portfolio, but a poorly managed business, a poorly done merger. We're starting to leg in, and we see other value activists get in trying to change the board. That's always a good sign. So in many cases, we don't think we need a monopoly on an idea. If we can hear an idea here, and then we do our own research and it works for us, that's great. We'll take it where we can get it.
And but you're not an activist in the stocks, like taking position in the board, or
we're not active. I mean, we'll get involved every once in a while, but when you look at it, when you're buying a company, in any proxy votes, we tend to always vote with management. If we don't like them, we're not going to buy the company. Some managers get in, and we have our clients' money we're using as well as ours, but it's not good to fight a battle with someone else's money, trying to win it, trying to change a board, and if it doesn't work, you lose the money. So we don't want to take that kind of gamble. Will we join up with other activists when they move it? Yes, but usually, having shareholder activism, we will get involved, but we don't have the size, nor do we want to spend the time, nor take the gamble on some companies that it's not going to work and lose money.
Thomas, after such a long time in the industry, do you have any recommendations, any lessons learned from you? You have seen the dot-com bubble, last financial crisis. Anything you would like to share with us?
Yes. Yes, I would say one lesson you learned is if everybody gets greedy, you really have to be careful. And even more important, if everybody has fear in his eyes, then you have good times. And then you do your analysis, you see the value, and most important, then you have to act. You have to invest, because I think there are a lot of smart people outside able to value a situation, to value a company. But finally, they do not have the guts to act if everything is only black in the markets. And I think this is finally, it's a psychological game. You have to be able to really do what's right and not to go with the herd. But as I mentioned, this is very, very hard if you are in an organization. I think many of you know how it is. And it's also hard with your clients. I mean, if everybody has fear and they have lost a lot of money already, and you tell them now it's time to invest. So it's not so easy.
I mean, I agree. When we founded the fund in 2009, I mean, everybody was saying, well, are you crazy to launch a private equity fund? Are you crazy to launch a listed private equity fund in 2009? It was basically impossible to raise any money, but looking back, it was the best time just to invest.
Actually, you have to be ready to risk your company.
That's right.
Yes, yes.
I should just add to that, I was taught about 25 or 30 years ago, if you remember in the old days, people, when you had to buy a stock, you'd have to write out a buy ticket. And an older portfolio manager taught me that if your hand's shaking when you're writing the ticket, it's a good buy.
No, I think we have now roughly 10 minutes left. I'm convinced there are also questions from the audience, so maybe, raise your hand and ask your questions. Volker, you would like to start?
I would be interested, since you guys are really looking at individual company situations and interest rates have been at record lows for such a long time, do you see any signs of excess on the company level where people are becoming careless dealing with credit?
Actually, I'm not in the loan business, so I don't know if you talk to private bankers and they have the clients. As far as Switzerland is concerned, I do not see a lot of this stuff. On the contrary, I think the whole recovery from 2008-9 when people didn't like it. I mean, everybody said, well, the world is not a good place. There are a lot of risks. We don't like it. You see the level of cash. It's still, in many banks, you have 20-25% of cash. And I couldn't see a switch from bonds to stocks as well. So people are hesitant. Maybe in Canada it's different, or in the United States, I don't know.
No, I think that the repercussions of the credit crunch still come home to roost. The major banks, the ones that are too big to fail in the States, still have higher capital. And when you look at the Basel Accord, just being up the road, they're adhering to that for the first time ever in the States. I shouldn't say first time ever, but they're really hoarding capital. So what's really gone on in the US markets is the larger banks are only lending to the highest credit quality companies. In fact, there is a little bit of a problem. It's a bifurcated or two-tiered market in the States for lending. If I need money and I can't get it from a bigger bank, I have to go to a smaller place and pay an enormous amount more than the going rate just to get it. And so I think that, it's actually almost a different problem in the States. You've seen not as much loan growth to smaller businesses. And one of the things that you were talking about is they pump the money supply. But I remember going back and learning in economics, what it really meant was a velocity of money, how often that money turns over. It's called V2 in the States. I haven't looked at it in maybe a year, but it was at its lowest level. And so I think that the big thing with the economic recovery is as that starts to recover, that's actually a good thing. Will we get into some sort of credit bubble again at one point? I don't want to call it a bubble, but yes, but we're not there yet. But absolutely with human nature, we will get there at one point, Volker. The only other thing I'll mention is that with rising rates, you've had a cost of capital that's basically been nothing. And a lot of companies hoarding cash, paying debt at 2% and just sitting on that cash. That will change. You're starting to see more capital expansion today and investing in the future. So it's just something to watch and watch carefully.
Any other? Yeah.
Maybe a question to both of you. What was your biggest mistake that you made, and why did you do it, or what was the reason for the mistake?
Tim, you first.
I remember it was a Canadian company, and in Canada it's a little less of a liquid market, so we tend to go with 4% positions, but for smaller positions we might only hold 1 or 2%. We invested in a company called Livent. They did theater productions. They were based down the road, knew what they were doing. You'd know all the shows they did, and it was coming up quickly. And everything was great. Somebody thought when we were investing that there may be some problems in that the owners of the company were taking too much money out, so some shareholder activists got involved. And so anyway, one day, it was 1% of our portfolio. I'm walking up the road, and I see police cars coming to their headquarters. What's this? And anyway, not that that always happens, you're usually removed from it, and it turned out to be outright fraud. And you had some big money managers from the States being involved in it and everything else. And people lost a lot of money. And I think that one thing in a mistake, that type of thing, should we have known the character better? I think the people were pretty prominent people who had been in the industry for quite a while. Yes, we should have. But some things, sometimes you don't know where your mistakes are going to come from. If you did, you wouldn't buy them. We are just very happy it was a 1% position. So beware the police cars.
I guess our biggest mistake over the 20 years has been not to recognize the severeness of the financial crisis in 07-08. So we really got surprised by the credit freeze and the analysis, what that meant to our companies, or some of them. Actually, I think we were clearly behind the curve. So we were invested in IndyMac, a mortgage lender in California. We traveled, I think, 3 times to California, talked to the management, and the stock price was going down and down, but we did not realize what really was going on the ground in the United States at those days. And so we ended up with a complete loss. There are other lessons I can tell you. In general, you have to be very careful with US companies, because if it's going to become problematic, the management is going to run into Chapter 11 immediately, or very fast, because for them, it's no issue. They get new stock options, they keep their job, but you as an investor, you are wiped out. So if we invest in US companies, we are much more careful today than as we have been before, because as Swissies, we are not used to this kind of handling the issues. In Switzerland, usually you have burden sharing. I mean, the bank is taking some write-offs. You have a capital increase, which is diluting you, but not wiping out. The bondholders burden their share, so it's quite different. For example, Georg Fischer, for example, I think they wouldn't have survived in the US, but they did survive in Switzerland. So this is a lesson we had to learn on the hard way, and I'm a little bit ashamed. I mean, I was more than 50-year-olds even then, and it happened, but it happened. So this is a huge lesson. Actually, after what happened, we introduced a systematic risk test where we stress such situations. And after 2008, there are some cases we would have invested because the fair value was really very high with regard to the stock price. But the risks, this kind of balance sheet risk and refinancing risks, we are weighting them much higher. And the second thing is, I mean, the margin of safety maybe is also dangerous, because yes, you can have a huge margin of safety if you take average margin, average multiples, and you do the DCF on these average figures, but if they do not survive, even a huge margin of safety, defined as I just did, doesn't help you. So yes, unfortunately, we had to learn a lot.
Yeah, thank you very much. So, yeah,
I should add just one thing. He mentioned Chapter 11's great source of new ideas, by the way.
If they come back.
If they come back,
Yes.
but when they're in the middle of it, usually no one wants to touch them. And we've had one called General Growth Properties, a U.S. shopping mall REIT, that went into Chapter 11. We were able to buy it very cheaply, and it's done very, very well for us. So they sometimes they're a great source of buying after the Chapter 11.
great. Yeah, thank you very much, Thomas and Tim, for your very interesting insights. And now I think it's time for lunch.
Yes, well, we don't have any lunch, I'm afraid. But I can tell you, Thomas knows this, and Michelle as well. Tim in Switzerland, if we want to calm our nerves, we have some chocolate. So this is the best chocolate that Zurich has to offer, one for you as well.
Thank you. Thank you.
Michelle, thank you very much for being here and passing on your wisdom. Round of applause. Thank you.